Are we due for more rate cuts? And how does the Australian Reserve Bank actually determine this, and what's in store for the housing market over the next 2 years? Now, you've all been hearing about a lot of rate cuts and economic predictions lately, so I thought it would be a really good time to jump on here again and talk about this in a more educational way and make it as easy for you to understand. Plus, I'm going to share my own insights into some of the most respected sources in the field, so you can make a well-informed decision on whether, as an investor, first home buyer, or just someone interested in the economy, what you want to do. So let's get started. First things first, let's talk about what interest rates are and how they actually tie into the economy. In simple terms, interest rates are the cost of borrowing money. The Reserve Bank of Australia, or the RBA, controls the cash rate, the key interest rate that influences everything from your home loan to your car finance and even business loans. So when the RBA raises or lowers the cash rate, it has a significant impact on the entire economy. The reason interest rates matter so much is because they affect consumer spending, business investment, and our housing market. So when rates go up, it costs more to borrow money, which can slow down spending and investment. On the flip side, when rates go down, borrowing can become cheaper, which can encourage more people to borrow and spend more. This is a tool that the RBA will use to either cool down or stimulate the economy, depending on what's actually needed at the time. Now, you're probably wondering, how does the RBA decide whether to cut rates? Great question. The RBA has a mandate to keep inflation in check and maintain full employment, so they use the interest rate as one of the key levels to control these economic factors. Inflation is a big one. If inflation is too high, the RBA may rise interest rates to make borrowing more expensive, which will potentially reduce consumer demand and help lower inflation. On the other hand, if inflation is too low or the economy is struggling, the RBA may cut rates to encourage spending and investment. But it's not just inflation. The RBA also takes into account employment levels, global economic conditions, and even factors like the Australian dollar's strength in the global market. For example, if the global economy is slowing down, the RBA might decide to lower rates to help our economy stay competitive. To make these decisions, the RBA has a monthly board meeting where they review a range of data, including GDP growth, unemployment rates, inflation, and more. They also consider the outlook of the global economy and any significant changes in financial markets. And based on this data, they'll make a decision to increase, decrease, or leave it unchanged. So now that we understand how the RBA makes their decisions, let's go to the burning question. Are we due for more rate cuts? Well, as of the latest data from the ABS and insights from the RBA's own reports, there is a really strong indication that the RBA could continue to hold rates steady for the time being. In fact, as early as 2025, the RBA has kept the cash rate relatively stable after a series of cuts in 2023. But here's the thing. There's always uncertainty. The global economy, especially with economic slowdowns in the US and China, could put pressure on the RBA to make further cuts. That being said, inflation remains a key focus for the RBA, and while it's been cooling off, they will likely wait until inflation reaches their target range before making any further moves. Australia's employment market has been surprisingly strong. The unemployment rate is sitting at around 3.5%, which historically is low, indicating that the economy is not in a dire state. This means that while rate cuts might still be on the table, the RBA is unlikely to make a drastic move unless there's a clear indication that inflation is under control and economic growth needs a further boost. So let's talk about what everyone's been waiting for, the housing market. With all this talk about interest rates and economic predictions, what we can expect in the property market over the next 2 years. Well, looking at the Australian housing market, it's clear that we've seen some interesting shifts. After the boom in the property prices during the pandemic, we saw a cooling off in 23 into 24, thanks to those higher interest rates. However, despite higher borrowing costs, the market hasn't come crashing down. Instead, what we're seeing is a period of consolidation. So here's what I think we could expect over the next 2 years. Stabilizing property prices. Property prices are likely to level off as the economy finds its footing post-pandemic. These sharp declines, some were predicting, simply haven't materialized in most major cities. In fact, places like Sydney and Melbourne and Brisbane, prices have been edging up against as demand remains really steady and supply is constrained. 2. Continued high demand for housing. There's no shortage of demand. Australia's population growth, driven by migration, is fueling demand for homes. In fact, the demographic shift is expected to continue, in particular in Melbourne, Sydney, and Brisbane. 3. Pressure on affordable housing. While the luxury market has cooled off a little bit, the affordable housing market is under significant pressure. High first home buyer demand, combined with limited housing stock, will likely keep prices for lower-priced homes and apartments elevated. 4. Interest rates and the housing market. If the RBA cuts further, it could provide a boost to the housing market, but the impact will likely be more gradual over time, as buyers are already adjusting to higher rates. So even with a rate cut, we may see some kind of little price surge and more confidence, but overall, it will probably level out based on affordability. Overall, I expect the housing market to remain stable with modest growth in some areas, slight correction in others, but it's really going to depend on the broader economic context, particularly decisions made by the RBA. Honestly, the biggest indicator for me here is what's going on in the global market and what we're actually seeing with the weakening of the Australian dollar. So my prediction is to safeguard Australia, we may see those interest rate cuts come as we see more global impacts. Now that we've broken down the interest rate outlook and housing market predictions, what does this mean for you? Whether you're a homeowner, investor, or someone considering to enter the property market, it's crucial to keep a close eye on these developments. Here's why. Stay informed. Keep an eye on the RBA's decisions because those will be key signals for the future of both interest rates and the housing market. Plan your budget wisely. If you're looking to buy a home, refinance your loan, make sure you have a buffer in place in case there is an interest rate rise. And consult a financial advisor or your broker. If you're unsure about how any of this affects your personal situation, don't hesitate to book a session with an expert, or you can always book a session in with myself. Remember, the market isn't static, it's always evolving. By staying informed and planning ahead, you'll be able to navigate the challenges and opportunities that come your way.